It is my as a part of the member of the Chamber of Tax Consultant Delhi chapter, we always try to do and discuss the recent case law. And for this purpose here, we always try to encourage every member to come forward and take up some recent case law here. And this time we have selected some important case law of the ITR 474. And for this purpose, I'm really thankful to GS Pannu sir for his consent for the gracious and gracing the occasion for this purpose here. Pannu sir need no introduction here, although I have got his profile here, but I have been instructed to cut it short for 30 seconds here. What I can say that Pannu sir, being the acting chairman of the Income Tax Tribunal, which all chartered accountant and advocate know here, he was the vice president in Delhi, and particularly he has blessed us with so many judgments here, with so many guidance here, that apart from the official capacity, I'm very much personally thankful to you for gracing us and for guiding us and for understanding the case law, understanding the discussion, understanding the complicated income tax matters here. Pannu Sahab, I came to know that Pannu Sahab everyone know that he is a chartered accountant and he was the accounts member. But I recently came to know that he has completed his LLB and that is 2024. So we can understand his way of understanding the law and zeal to learn. And this zeal to learn has said that at this stage, sir has completed the law degree here. Very much thankful to you, sir, for gracing us. We have two learned speakers also, and I will hand over the proceedings to Smita Patni ma'am to introduce the two learned speakers here. And after that, we can start the discussion on the case law.
So good evening and a very welcome to all of you, sir. So, Sri Manoj Kumar ji Mittal is a law graduate and a practicing CA by profession over 25 years. He has been a part of Direct Tax Committee and International Tax Committee of ICAI since last 3 years. He is an executive member of IFA NRC, CTC Delhi. He is also a special invitee of ITAT Bar, Delhi. He has written various articles of professional interest published in various journals like Taxman, Tax Sutra, Tax Guru, ITAT Online, NIRC of ICI. He's also been a speaker at various places and various forums. Welcome, Sri Manoj, sir.
Thank you, Smita ji, for the kind words. And thanks to the Pannu sir.
Manoj sir, एक minute. Please allow Smita ma'am to read the profile of
sure.
Goyal sir also.
So, Sri C.A. Sunil Goyal is a fellow chartered accountant with a distinguished practice in income tax litigation and advisory for more than 15 years. He specializes in representing clients in tax assessments, appeals, and compliance matters, offering practical solutions with legal insight. Welcome, Sri Sunil Goyal, sir.
Thank you, Smita ma'am here. Before we start the discussion on the case law, and what I have discussed with sir also here, that to understand the case law, it is important that we should understand the legal principles of the case law. And for this purpose, we have selected 6 case law today. And that is the 6th case law is the Sanjay Baweja. That is the first case law that we're going to discuss. Raiki Kumar, that is the PCIT versus SVD Resins, Bunyad Chemicals, Karina Airlines, and Kanak Impex here. All are reported in the 474 ITR. Before we start here, may I request Pannu sir to say something on this type of seminar here, sir.
Thank you, Prakash. Well, congratulations to the CTC, Chamber for Tax Consultants. I mean, you are almost a century old now, or how?
Yes, sir. Yes, sir.
Almost century. So that's very, very creditable that, and the Delhi chapter is now carrying forward that good work done all the years with the legacy that you have. So, and in fact, when Prakash told me, Prakash himself is a very, there are professionals and professionals, but he's one professional who's quite studious type, and he likes to dwell into the subject, and which is a very good habit for that matter. So when he narrated to me that this is the seminar that we are holding, but what attracted me the most was the pointed discussion on the case laws. Well, you see, every case law has its own moorings in the sense that it is founded on its own facts. It's founded on the law that is being seen. And if I may put it like this, it is also founded in a lot of the manner in which the person writing the judgments understands and views the law. And that goes for every forum in the hierarchy. Made with the CIT, made with the AO, made with the tribunal, the High Court and the Supreme Court. Each has its own peculiar, maybe limitations, maybe visions that is required for that particular forum. So we must always bear this in mind that when we are reading judgments, say of an authority like CIT or tribunal, and in distinction to that, when we read judgments of constitutional courts, there is a flavor, different flavor itself. Because there is a responsibility which is attached to that formulation of the jurisprudence done by every forum is different. So with those, but certainly this is a very good way because this is one way to understand and learn the development in the subject. You see, if you all recall, the jurisprudence which was there 25 years or 30 years ago, it's all undergoing a change. Suddenly you find that the courts are a bit pro-revenue as some people say. But all along the fact is that the courts are pro-law for that matter. But yes, in some cases where there is a discretion of taking a view, there is keeping in tune with the contemporary times, the jurisprudences can have its own vacillations at times. So today we are in times where a lot of emphasis on good governance, on requirements of meeting up with the standards of ideals of expected of a good and compliant tax behavior, not only within the country but cross-border transactions have come to fore. So you will see the jurisprudences being slightly more strict in the sense of the compliant nature. Because of the technology involved, there is so much information which is there on the other side also now, which was not there in the earlier regime. So therefore, all these factors play a part in what the jurisprudence is developed over a period of time. So in my opinion, what you people are decided and to do, and there's something which is very, very relevant and contemporaneous for the times that are also coming ahead for us. So with these remarks, I think we can leave to the speakers to actually take up because that is going to be the meat of your session, and all the very best. I'm very happy to be with all of you and thankful to all of you for this matter. Thank you.
Thank you, sir, for your kind opening remarks. And the word that you have used, studious, here. I think in our whole group, Ashok Sharma sir is the most studious person who is going to moderate this session, sir. Ashok Sharma sir from Bombay, he is joining us, and he is graciously agreed to moderate this session, sir.
Ashok Sharma ji, I have been watching him in fact, he has watched us.
Yeah.
He's senior to us in age, so he has seen people on the bench coming and going. So
Yeah.
to that extent, what his nature is something very, very, that they need not be described. All of you know about it.
Yeah.
I today wanted to encourage the Delhi chapter. So that is the reason why I took the name of the Delhi chapter. Bombay
Yes.
people, anyway, they are, frankly, in my long career in the tribal of 24, 25 years, and otherwise also in the profession before that, the work culture, which is prevalent in Bombay, the western part of the country, and also the professionalism attached to the subject as such. You have such good forums there of CTC. You have Bombay Chartered Accountant Society. the journals which they come out, the CTC publications which are in so many in number, and you're holding the moot courts there for regularly for X number of years. So, there is a culture there, and Mr. Sharma is presenting that culture. So full marks to the people, and I really wish that the Bombay people, align with the Delhi chapter more and more, and we also develop the culture in Delhi also, for that matter. Full marks to that. Thank you.
Thank you, sir.
Thank you.
Now, may I request Manoj sir and Ashok Sharma sir to start the proceeding here. Ashok Sharma sir.
Sir, you are on mute, sir. Mute, sir.
Yeah, I will straightway request Manoj sir to start the discussion. And thank you so much, Sinaji and Pannu sir. I'm just a student of and I have keen interest in the studies only. Thank you. Yes, Manoj sir.
Thank you, Ashok ji. Respected Pannu ji, Honorable President, Honorable Ex-President of the ITAT, Prakash ji, Harpreet ji, Smita ji, and Sunil ji, and Ashok Sharma ji. First judgment I am going to take, I'm just sharing my slide. It's coming over there.
Not
Yes, sir.
yet, sir.
Visible. Visible.
Yes,
Thank
we
you.
can see that.
It's a judgment of the Honorable Delhi High Court in the case of Sanjay Baweja. The issue in the case was where a stock option is given to the assessee and he does not exercise it. And ultimately that option is diminished because of certain reasons, and he is paid lump sum amount, whether it is taxable as perquisite under section 17, subsection 2, clause 6. The facts of the case are that the assessee is an employee of Flipkart Internet Private Limited in a small called FIPL. FIPL is a subsidiary of Flipkart Marketplace Private Limited, that is small called FMPL, and FMPL is a wholly owned subsidiary of Flipkart Private Limited Singapore in a small called FPS. The FPS rolled out an employee stock option plan called as Flipkart Stock Option Plan. We shall call it in small FSOP, wherein the FPS granted certain stocks option to the eligible persons, including employees of the subsidiary. Ms. Sanjay Baweja also got that stock options. As per the clause of FSOP, the petitioner was granted 1,27,552 stock options on and from 1st November 2014 to 30th November 2016 with a vesting schedule of 4 years. Means over the period of 4 years, he will be granted the stock options. The issue was granted with respect to its wholly owned subsidiary called PhonePe. Means the share will be issued in the company of PhonePe. The assessee employment was terminated on 31st October 2016. This is an important date. On December 2022, FPS announced the disinvestment of its wholly owned subsidiary called PhonePe. Now, the stock option is not possible because of disinvestment of the wholly owned subsidiary PhonePe. So, in lieu of that stock option, the FPS paid compensation to the holder of the stock option as on 23/12/2022. Furthermore, it was also stated that the FPS would be withholding tax on the said compensations. In May 2023, assessee ex-employee preferred an application under section 197 seeking a nil declaration certificates on the deduction of TDS by the FPS. In July 2023, Revenue passed the impugned order rejecting the petition application on the score that the amount received would be in the nature of perquisite under section 17, subsection 2, clause 6 of the Act. So this is the issue involved and facts of the case. Now, issue is whether the one-time voluntary payment made by the FPS to the petitioner who had not exercised a stock option qualify as a taxable perquisite under Section 17(2), Clause 6 of the Income Tax Act. Law involved is Section 17, subsection 2, perquisite. What is perquisite? Includes the value of any specified security or civic equity shares allotted or transferred directly or indirectly by the employer or the former employer, or free of cost or at concessional rate to the assessee. The main important point in this, that there should be an allotment or transfer. And as we see the fact of the case, the shares are not option neither allotted and nor transferred. Once they are not allotted and transferred, whether it can be a perquisite. So this is the picture of that. These are small brief of the events. The option granted 1,27,000. Vested option up to 1st November 2015, 31,888. Remaining 75% to be exercised. Vested option up to 31st/10/2016, up to the date of his resignation, 31,884. Total vested option 63,772. It means once he resigned, so the remaining option got cancelled on the date of his resignation. That is 63,000. Option purchased by Walmart 15,953 and 14,347. But the case does not deal with the tax treatment of this option purchased by the Walmart. So total balance as with the assessee 33,482, for which the compensation paid at the rate of which 43.67 per dollar, that is multiplied by 82 to 11,98,097 rupees, he got the compensation. So on the facts of the case, revenue argument was that payment was in the nature of perquisite under Section 17(2)(6) as it related back to the stock option granted by the employer. Contended that since FPS intended to deduct tax at source, it indicated the payment's taxable nature. Assessee contention, the assessee claimed the payment was a voluntary, non-contractual compensation and thus a capital receipt not liable to tax. Highlighted that stock options were unexercised, hence no perquisite arose under Section 17, subsection 2, clause 6. Emphasized that there was no existing employment relationship with the FPS at the time of payment. Relied on Supreme Court ruling in Sriman Padmaraje R. Kadam Bande versus CIT and Godrej and Company versus CIT, which distinguished between capital and revenue receipt. In the further finding of the High Court, recognized that payment was a one-time voluntary compensation by FPS, not arising from any contractual obligation, because there is no contractual obligations. But I feel stating that not a contractual obligation, once you have allotted the stock option to the assessee and you yourself by your some of the mode diminish his right to get out of that stock option and paid one-time compensation. So saying that you have no contractual obligation, I'm not clear about it. Noted that petitioner had not exercised stock options, thus the condition under Section 17(2)(6) were not met. But whether he could exercise it, because prior to his exercise or the period available to him for exercise, you have disinvested from the company from which the stock option was to be given to the assessee. So taking this plea, I'm not able to capture. Determined that the payment was a capital receipt not taxable under the Income Tax Act. Judgment, the Honorable Court quashed the A order dated so, which had denied the nil TDS settlement. But reasoning of the order that perquisite taxation under Section 17(2)(6) arise only upon exercise of stock option which had not occurred. Acknowledgement that payment was made voluntary without any legal or contractual obligations and thus did not constitute income. Aligned with the precedents, distinguish between capital and revenue receipt, reinforcing the non-taxable nature of the payment. But there is a contrary judgment of the Honorable Madras High Court in the same case, which there was another employee who was of the jurisdiction of Madras High Court. So Madras High Court took a contrary stand. SSC was salaried employee of step down subsidiary of FPS. SSC held stock option of FPS. Thereafter, FPS announced this investment of stake in certain company. Pursuant to said disinvestment, value of stock option fell. Consequently, the SSC received compensation for said loss by deducting tax at source under Section 192 and treating it as falling under that salary. SSC requested for a nil certificate of tax deduction at source by filing an application under Section 197 on the ground that amount received as compensation was a capital receipt, which was not liable to income tax. It was noted that SSC received a substantial monetary benefit at pre-exercise stage by way of discretionary compensation for diminution in the value of stock options. Whether since SSC did not exercise options in respect of any vested issue, and consequently shares of FPS were not issued or allotted to the SSC. SSC neither received nor transferred capital assets, held yes. Whether since SSC did not make any payment towards ESOP and continued to retain all ESOP even after the receipt of compensation, but there is no logic to retain the all ESOP because ultimately there has been damage, disinvestment in the company from which the ESOP was to be issued. Entire receipt would qualify as a perquisite and would become liable to be taxed under the head salary. Held yes, whether this compensation would qualify as a perquisite and not capital receipt, and SSC would not be entitled to a nil certificate of deduction, held yes. So now there are contrary judgment. One of Delhi High Court stating that there is no taxability under Section 17(2)(6), and Madras High Court that yes, there is a taxability. My observation is that if you look at Delhi High Court order and Madras High Court order, with due regard to the Honorable Madras High Court, Delhi High Court seems to be on the more in line with the law because 17(2)(6) can be invoked only when the share is transferred or the allotted. I just go back to a definition again of that. Perquisite includes the value of any specified security or sweet equity shares allotted or transferred, directly or indirectly, but there is no allotment. Once there is no allotment, so they cannot be perquisite under Section 72(6), as there cannot be liability in the hand of the assessee. Now the question arises whether the assessee will go scot-free and he will not be taxable. In my humble view, he may be covered under Section 17, subsection 3, clause B, which provides any amount due to or received, whether in lump sum or otherwise, by any assessee from any person after cessation of his employment with that person. So maybe he covered into that. But the question is cessation of employment the person or from any person, means the person who is paying and the person with employment should be same, they are different. Maybe taken or not. This is the question. And further, Section 56(2)(10), because you are receiving, if anything, voluntary without any relationship, why not Section 56(2)(10) should be invoked? Now the question arises whether High Court can give the direction for 10(3)(b) or 56(2)(10). I think High Court, I'm not sure about it. I've looked, sir, to advise us, Pannu sir, that whether High Court can go beyond the assessment order. What has not been proposed by the assessing officer, not dealt with by the CIT appeal, ITAT, whether it can be dealt at this stage or on the plea taken by the department at High Court stage, whether it can be entertained or sent back to the assessing AO to look into these sections. These are my questions here. Because ITAT cannot go beyond the assessment order, we are clear about it, but not High Court. Further, even if employer deduct TDS, but as we are saying, it's a voluntary payment, one-time payment, whether the employer will be able to claim the expenditure of it or not. Sir, with these questions, I conclude it and I look at the sir and others for their thought process on this segment, sir.
Yes, Pannu sir.
If somebody wants to say something before we start.
Yeah, one question is there. Madras High Court has taken a contrary view, as Speaker said, few in the case of the field so and so. Are there any distinguishing facts in the case before the Delhi High Court and Madras High Court? This is a question from one participant. Manoj ji, would you like to reply this?
In my view, first and foremost thing, there should be allotment of share and transfer of share. In the both the cases, there is no allotment of share, no transfer of share. Hence, section 72(6) cannot be invoked. Sir,
Okay.
this is my view.
All right.
Okay. Yes,
See,
sir. Pannu, sir.
all right. So you see, let's see. Our base for today's discussion is the Delhi High Court judgment of Sanjay Baweja. So I thank you, of course, Manoj. You have dealt with all the intricacies involved in it. Your last point first, where you said that whether the High Court can change or include or vary what it is. Actually, coming to the position on hand, we must first see that Sanjay Baweja's case, it is not a case where the High Court was approached under section 260A with a question of law. No, it was in a writ jurisdiction. So and the writ jurisdiction, the relief sought was the directions to the assessing officer for denying the assessee's application under section 197, seeking nil deduction of tax at source. So therefore, the issue which was there before them was very, very limited, and they were guided by the order by way of which the application of the assessee under 197 was denied. Now, they have, of course, said both the things under the facts. That 17(2)(6) does not come into operation because the option was not exercised yet by the assessee, even when the compensation was paid. Now, similar was the situation in the case of Madras High Court. I have not read Madras High Court, of course, but there also the finding is that it is salary 192 will come into play for the purposes of TDS, and for the reason that it is a perquisite in section 17(2)(6). So that to that extent, it's a contrary decision. But let us focus first on the Delhi High Court, and that will enable us to understand perhaps the vacuum or something which is missing in Madras High Court, and then help us in making up our mind. You see, and this may also be maybe one of the reasons why the two decisions ended up the way they are. You see, in the case of Delhi, if you read the judgment, they have also dealt with how the assessing officer denied assessee's claim for nil deduction of tax. Another one fundamental aspect we must also keep in mind is what was the reason for the company having paid this one-time compensation. You see, one of the divisions, one of its own subsidiaries, that is PhonePe, was divested. So obviously, this gentleman had the option to take the shares of Singapore company. So when one of the businesses were divested, the resultant option would obviously not have the same value what it used to be before this business was divested from the Singapore company. And therefore, considering that there is bound to be a diminution in value, and that is precisely what the Delhi High Court has also reproduced the minutes of the resolution passed by the board of directors of the Singapore company when it decided to give this one-time option, one-time compensation. Why I am emphasizing all these facts is it will help us to understand the reasoning and the logic which prevailed with the Delhi High Court. So if I will just read out a few lines from there, with the announcement, I'll just say with this announcement means the announcement of divestment of PhonePe. With this announcement, the value of employee stock option plans granted to all stakeholders, including present and the former employees in our subsidiaries in India, Israel, US, Singapore, Saudi Arabia, China, etc. So all across the world, they had their employees. That will drop, along with the loss of opportunity to share in future acquisition of the value of PhonePe shares. The board was conscious, the board of the company was conscious when it says, while there is no legal or contractual right under Flipkart stock option plan to provide compensation for loss in current value or any potential losses on account of future accretion to our employee stock option plan holders, the board of directors on its own discretion decided to place so-and-so as a one-time measure. So, they were conscious as to what is being done. So therefore, you would find when the High Court gives a finding that there was no legal, statutory or a contractual obligation for them to pay this compensation. And that is why they have gone back to the general jurisprudence that an amount which is paid towards, whether it is capital or revenue amount which is paid for sterilization of a source of income, or it is in substitute for an income. They have also said and drawn to the earlier case laws of Honorable Supreme Court and the English law to say that if there is a part sterilization of the source of income also, it will also the same category of being capital in nature. They went to that extent to distinguish and appreciate that position was to only emphasize that it is only one portion of the entity as a whole, that the divestment of one portion of the source was being taken away. And compensation in lieu of that will also have the same bearing of nature. That is why they said that there was neither a contractual nor a legal requirement. So therefore, as a one-time measure, which was to compensate for a sterilization of a part sterilization of the source, that's the reason why they said it to be capital and not chargeable to tax, rather. Let's put it like this. It's a voluntary payment. See, another aspect we must also see is that, in a way, actually, the revenue, when the revenue took 2-3 arguments. One of the argument was, look, the payer of the amount to you has also indicated in its communication that the applicable taxes at source will be deducted. So therefore, the assessing officer says, look, the payer of the income itself is saying, so you can now say that it is not taxable at all. So therefore, you give me nil certificate. That is why the High Court went back to the established maxim that it is not the question of how the payer treats that amount in his hands. It is up to the recipient and the nature in his hand which has to be tested. That is why they went back to parachute and everything. All that discussion is there. It is for that reason. Another aspect which was taken, and in fact, I think a bit strange. And that is why perhaps the High Court has also reproduced some portion of the order of the session officer under 197 denial, where it is averred in para, the compensation is linked to the vested employee stock option plans in the instant case, which enable a formulation of belief that even the assessing officer probably understood that it is not linked to employment but to the loss in the value of options. So therefore, apart from what 17(2)(6) said of not being triggered because unless the excess option is not taken place, notwithstanding that, they have also said since it is linked to the loss in the value of options and not linked to employment. That is why Delhi High Court also emphasized on this when it concludes the judgment. And of course, the first thing which they said is the 17(2)(6) not attracted because there was no exercise of option, and therefore it does not get triggered. And the nutshell, the conclusion of the High Court is it does not constitute income chargeable to tax, as none of contingencies contained in section 17(2)(6) have been fulfilled. That's one part of its conclusion. Nothing more, nothing less. And second part is that the compensation was voluntary and not by way of any obligation by which was transferred. So, not being linked to employment, it's linked to the loss in value of options. It's a one-time measure, one-time voluntary measure. So they have analyzed it from both sides and come to the conclusion. That is the gist of what the Delhi High Court has said. And Manoj, you had one more point. What was that?
Sir, whether it will be covered under section 17(3)(b), 56(2)(10).
You see, first of all, anyway, this was not the point of point which was brought out before the High Court.
Yes, sir.
The simple reason, but that was not the case set up by the assessing officer to deny the nil certificate. And that is the reason why you would see when the revenue's counsel, he opened his arguments. His first submission in para 11, I will just read, is an indication of the importance of that. He submitted that proceedings under section 197 of the Act are not a fact-intensive exercise, and rather it's an administrative exercise. And therefore, the assessing officer was not obligated to dive into the matter to determine whether the stock option was exercised with the petitioner or not. No, this is something which is absolutely, he was not entitled to dive into the matter to look into its absolute taxability, fine, but whether an option was exercised or not is something which was on the face of it before it. So therefore, he's trying to put up walls. Look, I am not talking about taxability here. I think this is the fundamental difference if you see between what probably, I have not gone through the judgment of the Central Honorable Madras High Court. This probably is something which has probably not been argued, brought out in that manner before the Honorable High Court in Madras.
This fact, the basic fact in both the cases same that the option has not been exercised. In both the cases.
Exactly. So therefore, 17(2)(6) is a non-starter unless the option is not exercised.
Yes, sir. And moreover, one point was, as the company was going to deduct TDS, whether TDS will be applicable, whether the company claim an expenditure when it is said it's a voluntary, not related to employment, then it's not related to business also.
The point is that aspect has been answered by the Delhi High Court in the sense that you cannot be guided by what the payer of the amount will be deducting. You have to independently analyze, which they have analyzed.
Yes, sir. There is a para for that.
So far as your question on that 17(3), I think that's what, no? 17(3).
Capital B.
17.3 capital B. Yeah. Profits in lieu of salary.
Yes.
Any amount due or received, whether in lump sum or otherwise by an assessee from any person after cessation of his employment with that person. No question.
Only catch here that person should be same, employer should be same. And in our case, employer of holding company and here the subsidiary company.
You see, this is a very, I think we are on a very thin ice. The whole, you see, that is why I think I emphasize that the revenue also contended that it is not linked to employment. Otherwise, frankly, the stock options facility is available only because of employment with that concern.
Yes, sir.
So now, and in the case of the Delhi High Court, the concerned person had already, left the employment. I think, if I'm not wrong,
Yes,
he
yes,
was
left
no
the
longer,
employer.
when all this happened, he was no longer in employment with the. So therefore, for that reason, he was covered because the board of directors decided to pay this compensation to the employees as also the past employees also were holding the ESOP. To that extent, he was covered. To that extent, frankly, so therefore, this 17.3 is in profit will your salary. So unless there is salary, the 17.3 itself is in lieu of salary. So unless there is salary, it's a deeming thing what they said in the amount due or received, whether in lump sum or other, after cessation of employment with that person.
They are deeming it as a salary.
Correct. But then once the High Court looks at it as not being linked to employment, and assessing officer willy-nilly also agreeing to that proposition when he is writing 197, it's very difficult for them to turn around and say, look, now I will tax you in 17.3b, 33b. You understand?
Yes, sir.
See, one can only, that is why one should be very careful with what is being argued, what should be argued and what should be, the way it is disposed of by the authorities also. So
What
there
about
is
the 56 to 10?
56 to
10 is regarding
no,
any
but see,
holding
that probably was also in the mind. That's why I was wondering as to why this, why the second finding by the Delhi High Court of saying, look, it is voluntary, it's a one-time measure, no contractual obligations. Whether it is capital or revenue. So 56.2 will not catch it in that case. So no, they probably had that in mind. That is why they're saying it is no income which is not flowing out of any on revenue account, but it is on capital account, not chargeable. 56.2 does not any such things. Now, another question which is just come here is that why could it not be plain salary under section 15? So Manoj, what do you suggest on this? Why not just plain salary as generally?
There's a question over here.
Yeah, there's on the chat box. If you see, I just saw.
Okay.
His point is they have according to him the Delhi High Court says between capital and revenue it's capital, but other charging section, for instance, why not be salary in 15 itself?
Section 15 has 3 ingredients into it when it can be taxed. Section 15, 1, 2, 3. If we go to it,
right. So A, salary due, is not salary paid allowed to him. Any arrears? No.
Fall into anything, sir.
Yeah.
Now, salary, if you go by, it's maybe covered in the perquisite, but it's not covered.
Salary includes perquisite, so therefore.
Not the perquisite, because of definition of 72.6 check
Correct.
given.
Correct. So per se, it is not salary.
Yes.
Correct. So that is the point.
Any other questions are over here?
No, but there's about 56.2. See, fixes 56.2 is a is a residual clause which charges certain receipts as income, but provided they are to be taxable as incomes on revenue account.
Yes.
So
Or
that is
under
why
which-
one of the gentlemen, Mr. Subramaniam has asked that question on the chat box. So therefore, you will find that the Delhi High Court also repeats when it starts discussion on the capital revenue that all receipts are not income. That's why it refers to that kind of scenario that they have. This is what they had in mind.
And moreover, under section 56(2), which clause you will cover? Mr. Subramaniam, there are 7 to 8 clauses.
Correct. That's another one.
Yeah. Under 10, sir, if you look at 56(2)(10), clause A, why it cannot be covered over here?
What is 56 to 10?
This is any 50, let me read, sir, where any person receives in any previous year from any person on or after 1st April 2017 any sum of money without consideration, the aggregate value of which exceeds 50,000 rupees, the whole of the aggregate value of the such sum.
No, Manoj. But see, 56(2) also covers income.
Sir, it covers capital receipt also.
56(2).
Yes, it's a deeming fiction.
Let's see.
56(2)(10),
I did not see from that angle.
any sum of money.
56(2).
In fact, this section is being used by the government as a deeming fiction whenever they find that there is a lacuna in the Income Tax Act, they put it over here.
Correct, but that is by specific insertion.
Yes.
In particular, the following income shall be chargeable to tax under the head income, namely 56(2). Now we go to 10,
56(2)(10), clause 10.
where a person any sum of money without consideration, the aggregate value of which exceeds. This is the one you were saying.
Yes, sir.
So how do you say that this includes a capital income also?
It includes here. Read a full section over here. Any whole property without consideration.
No, that is B. But we are in A only, no?
I am telling you the nature of the section by putting it.
No, but you see, that is specifically, no, they have provided it so. If you look at the beginning of 56(2),
even sir, it recovers gifts also. If you receive any gift without consideration.
So therefore they have enumerated it as such.
Yes.
In particular and without prejudice to the generality of the provisions of subsection 1, the
Yes.
following incomes shall be chargeable income tax under the income other sources, namely, then we go straight to 10, where a person receives in any previous year from any person or person any sum of money without consideration. So therefore it is this sum of money cannot be beyond what is there as income unless specified so. So when the Delhi High Court went on to say, look, no, this is not income in the revenue nature, it is capital. So therefore, that's it. So that is the reason 56(2) to our mind may not be a good charging section.
Okay,
You
sir.
are right, sir. If at all, it could have been taxed as perquisite under their salaries. But as sir, if that Lalitan Ambalal Modi, if particular income cannot be taxed under a particular head, then you cannot go to income from other sources. And as you rightly said,
Sir,
capital receipt.
if you read section 56, section 2, clause 24, clause 17B, it covers it first as an income.
56?
Right, section 2, clause 24.
(224), yes. Which section?
Clause 17A.
Correct.
Any sum of money.
Right. No, but the point is, they say it is not a revenue income, it is capital income. So they have said that capital receipt. That is the question.
Okay.
That is the reason. You got the point.
Yes, sir.
They have taken through all the judgments we talk about as to what can be taxed as what receipts can be as a taxable income, what is as a capital not subject to the charging provisions.
Okay, sir.
So that is why they say that this is any amount received. I'll just read a few lines. So one set of judgment they decided, they quoted was as the quality of payment is decisive of the character of payment and not the method of payment or its measure, which will make it fall category of capital revenue. So that is why when the AO was saying, look, the man is to deduct TDS when he's paying, so it is income. Secondly, maintenance, they were referring to another judgment where it is purely discretionary payment. In the present case, where it is purely discretionary payment, so therefore they said there is no enforceable right, so therefore it cannot be income. One-time payment was given to an assessee company in lieu of change in contractual terms between the assessee company and the management company. Godrej and Company, Supreme Court, they have referred to for this matter. They also refer to Shaw Wallace and they say a compensation to be regarded as capital is not necessary. The entire agency should be acquired. So a portion of the agency was surrendered and the compensation was given. Yet they said, look, because you are sterilizing only a part of the source of income, yet it will bear the same character of being a capital. So therefore, also, it is not that the entire option is wiped out. It's only a portion of it which is, there is a loss to be suffered because one unit has been divested. So there is a proportionate loss and decline in your value of to compensate that loss, part of it. So therefore, they said, look, even the part has to be taken as in the same character as what is to be taken as a whole. And in the background, that there was no exercise of option. So therefore, it qualified to be something which is not a receipt which is open for the charging sections. That is precisely what the Delhi High Court has viewed.
Thank you, sir. Thank you. In fact, I
Thank
got
you. Thank you for elaborate. Thank you for elaborate discussion.
Because if
Sunil ji,
you
you
see,
take-
para 25 is very illuminating.
Yes, sir.
When they talk of 72.6, they say, therefore, for an income to be included in the inclusive definition of perquisite, it is essential that it is generated from the exercise of options by the employee. The facts of the present case suggest that the petitioner has not exercised his option. Under the facts of the present case, the stock options were merely held by the petitioner. The same have not been exercised till date, and thus they do not constitute income chargeable to tax in the hand as 72. That is the precise reason they said. After having finished this, then they again discuss as to capital or revenue now.
Yes.
So they have tried to block from both sides.
Yes, sir.
But I don't know. Last is some, of course, is different. Yes.
So I, in fact, my other co-host is waiting.
Yeah. Please.
So we had like already 1 hour on the judgment.
We'll do it quickly. I think we'll do quickly now. I think.
Yeah. So now I give it to Sunil ji to carry on.
Sunil
Sir.
ji, please.
Thank you, sir, for such a deliberate, good, intense deliberation on this.
Yeah. All the best. Thank you. Thank you.
Yes, Sunil ji.
Yes, Sunil ji,
Thank
please.
you, Manoj, sir. Thank you, sir. Honorable Vice President, sir, Harpreet ji, Ashok Sharma ji, CA Manoj Kumar ji, Sumita Patni ji, and other members, good evening. I am going to start my presentation on SVD Resins and Plastic Private Limited.
Hello.
ये शेयर कहाँ से होगी जैसे डेस्कटॉप पे पड़ी है मेरी प्रेजेंटेशन
Manoj ji, will you please close your presentation? Sanjay Baweja, still it is on the screen. Hello, Harpreet ji.
शेयर कैसे होगी? शेयर पे क्लिक किया मैंने. Thank you. Good evening, friends. Sorry. SVD Resins and Plastic Private Limited. Facts of the case are SSC engaged in trading of resins and chemical. You found purchases from 6 parties listed as bogus by the sales tax department. AO made full addition under section 69C, alleging no nexus with sales. SSC filed ledger bills, delivery record to support purchases. Issue: can purchases be treated as bogus solely based on general information from sales tax department? Was AO justified in adding entire purchase value under section 69C? Law. Section 69C of the Income Tax Act 1961, unexplained expenditure, requires proper evidence to substantiate this allowance of expenditure. Argument: SSC submitted all documentation, purchases, genuine sale reported. AO relied on general info, did not corroborate with sales tax department, made full addition. CIT appeal estimated gross profit at the rate of 12.5%, reduced reported GP. ITAT confirmed 12.5% GP addition, which allowed deduction of reported GP. Reasoning: no conclusive evidence against excessive transactions. General info insufficient, case-specific inquiry lacking, need for coordinated assessing officer and sales tax department investigation. Addition should be proportionate and evidence-based. Conclusion in favor of SSC, no substantial question of law. Addition restricted to 12.5% on disputed purchase. Thank you.
Yes, sir.
It's answers of this SVD design.
Hello.
हाँ जी.
It's an end of judgment of SVD design.
हाँ जी, हाँ जी.
Sunil, I would suggest that there is another judgment of Bombay High Court which we are discussing today. That is
Yeah,
that
Kanak Impex.
Kanak Impex. I think दोनों इकट्ठे कर दो. Then we will know.
Yes.
I mean, it'll be easy to because it's apparently one judgment has gone left, other has gone right. So थोड़ा उसमें दोनों
Another judgment.
हाँ इकट्ठे कर दोगे ना तो it will be easier to.
Another judgment is Kanak Impex Limited. So the case is that SSC engaged in trading of iron and steel. Information from DGIT and Sales Tax Department revealed cases from Hawala operators. AO made 100% addition under Section 69C during reassessment. SSC did not appear. Notices were served by email post affixer. Whether profit estimation is valid where purchase are unproven and no explanation is offered. This Section 69C allows such partial relief. Law. Section 69C, where expenditure is unexplained, it shall be deemed as income. No deduction allowed for unexplained purchases. AO purchases bogus, SSC failed to explain or attend proceedings. Confirmed CIT appeal confirmed bogus nature but reduced addition to 12.5%. Tribunal upheld CIT appeal on estimation basis. Revenue challenged reduction, claimed full addition justified. Once purchase are found bogus, no explanation is offered, entire amount is taxable. Profit estimation gives undue benefit and violates Section 69C. Appellate authorities ignored statutory bar on deduction. Judgment in favor of revenue, full addition restored, estimation method rejected as illegal under section 69C. Thank you.
Pannu sir,
Hello. Yes, Pannu sir.
Oh, sorry, I was on the mute. I did not realize.
No, it's okay.
Sharma ji, you want to start with this discussion?
No, no, I know. Sir, in this case, what happens? Should we say that it was on the facts of the case? Because in the reassessment proceeding, nobody attended, and it was argued that in the original proceedings, we had just given the details of sundry debtors, creditor, etc. And in reassessment proceeding, nobody attended. Honorable the judges have said here, given one example, that this is just to make your black money white. In the sense, they have given one example that if Mr. A is having unaccounted money, what he will do is he will contact B, get bill from Mr. B, and after getting the bill, he will make the payment by check and receive cash back. And this way, this Mr. A's cash is being formalized. But here, sir, what I have seen is generally it doesn't happen like this. What happens is means in the that bill, there is no doubt that goods are purchased from grey market. Goods are purchased from grey market, and what happens, we contact a broker arranges everything, we make the payment to the through broker to the party, but he gives the bogus bill. Purchaser is not aware from whom he is getting the bill, etc. He receives the goods, he also receives the goods and bill also. And so, how far this is correct, and then because all the details were not there, I think judges have formed this opinion. But according to me, the example given by the judges is not is happening in practice. The goods are, see, all the tribunals and all the some high courts also have taken the proportionate. Even Bombay High Court in Mohammad Haji Adam, etc. They have they estimated the percentage of profit on the ground that no doubt the purchases are made, and there cannot be sale without purchases, and therefore they said purchases are made, but merely because it is from the grey market they have estimated the profit generally to the extent of GP offered, etc. So how far this judgment, but there are some one or two other judgment also. One is that Ganesh developers, they're also makes a similar, they're also 100% is estimated. But in that case, what happened? The judges have said because the supplier's bank account is not produced, we are not able to see whether cash was withdrawn. On that ground, out of some 7-8 parties, only 2 parties' case was not accepted because the bank account of the suppliers were not produced. So these are the facts, sir. But according to me, 12.5% number of judgments, tribunal, honorable tribunal, high courts have taken the view because it is not, it cannot be denied that goods were not purchased and sales are accepted. Our trading results have been accepted. Still, now in these cases, now they are saying 100% deduction is to be allowed. And according to me, 69C also cannot be accepted. Once I have issued the check in the name of the buyer through broker, it cannot be said that source is not proved. I have made the payment through banking channels, sir.
Right.
That is what I want to say. Yes, sir.
Right. So, you see, why I suggested to Sunil ji was that we can have both the two judgment together because it has some
No, it was
similarities.
yes,
Number
sir.
one, in both the cases, Section 69C has been invoked by the assessing officer. in both cases, some purchases have been found questionable and or bogus, because both words have been used in the two judgments together at the stage of the assessing officer. And both the additions were based on the information which has come from the sales tax department of the state, that the names of the two assessees, which are subject of discussion today, their names appear as having purchased material from certain dealers who have been found to be bogus or non-existent, as the words are interchangeably used in the assessments. Now, this is what the commonality is. The difference was that in one assessment, which is the first is the judgment in the case of SVD Resins, which is of August 24, and the other judgment is Kanak Impex of March 2025 by the Honorable Bombay High Court. Now, I will just read out the question of law which was answered by the High Court in the two cases. You will appreciate by reading those questions itself that how this litigation has moved. Although, as we found, as we understood, that both the additions stem from the same information, same genre. So, in this judgment of SVD Resins, the questions formulated were whether on the facts and in the circumstances of the case and in view, the Honorable ITAT was justified in restricting the addition under Section 69C of the Act to the extent of 12.5% when the assessee had failed to prove the genuineness of the purchase transaction in entirety. So this was the question. Of course, the second question is whether is not complying with another judgment of the High Court. I leave aside that question. Now look at the question which was before the Bombay High Court in the case of the second judgment, Kanak Impex of March 25. It says whether the tribunal, after accepting that this is a case of bogus purchases, could have proceeded to determine profit rate without confirming the disallowance of purchases, without considering Section 69C of the Act, and without considering the decision of the Gujarat High Court in the case of NK Industries, as the SLP against this decision has been dismissed by the Supreme Court in NK Proteins Limited. Now, the two questions itself are poles apart. In the case of Kanak, the question itself says, once it is accepted, it is a bogus purchase, can you still determine the profit rate within the mandate of Section 69C? The contours in the other judgment were that there is no acceptance of acceptance that it was a case of a bogus purchase. There, 69C itself, its applicability, the bogus nature itself was questionable in challenge. And 69C, having been challenged by assessee at every stage, was noted by the High Court in the case of SVD. Whereas it is noted to the contrary in the case of Kanak, where they say that invoking of Section 69C by the assessing officer In an ex parte assessments, of course, the person did not cooperate. Again, on that non-cooperation also, the High Court has found fault with the assessee. They have brought out. They say that the 69C AO held it to be bogus purchases. This thing was not challenged as much before the CIT bill or the tribunal. Because what the CIT bill, so therefore this is what is the distinction between the two. So therefore the profit rate could not have been gone into it as per the High Court in the case of Kanak. Now, it is not that the High Court was not aware of this kind of a situation vis-a-vis section 69C in the case of SVD. But what they say is there was an absence of proper proof of bogus purchases. And therefore they went along with the theory. Why they say no proper proof? They have brought out the specific information qua the assessee or qua the transaction of the assessee were not brought out and furnished by the assessing officer after having got the information from the sales tax department. So that is why they say that, in fact, in para 12 is very, very critical in that sense. A full edition could be made. I mean, full edition is what was made in the case of Kanak. So they are saying here in SVD also, in our opinion, a full edition could be made only on the basis of proper proof of bogus purchases being available as the law would recognize before the assessing officer of a nature which would unequivocally indicate the transactions were wholly bogus. In the absence of such proof, by no stretch of imagination, a conclusion could be arrived at that the entire expenditure claimed by the petitioner qua such transactions need to be added so as to be taxed in the hands of the assessee. So therefore, they go on to say that what the AO should have done in this matter, which he did not do, and therefore, in the absence of such cohesive and coordinated approach, because para 16 also is very, very, very telling, because they understood. See, they were, the assessee is, what has happened in the case of SVD was that some percentage was applied by the CIT bill. The tribunal also applied certain percentage, and both the parties, and therefore the revenue went to the High Court. The assessee is happily accepted such a finding as this has been benefit the assessee from looking from any angle. The finding of the was of 12.5% of the transaction should be taxed and not 100%. That is the CIT bill's finding primarily. And he reduced it by whatever his rate is declared, already declared by the assessee. The assessee has happily accepted such finding as this has benefit the assessee look from any angle. However, in a given case, if the authorities are of the view that there are questionable and oblique or bogus purchases, in that event, it is a solemn obligation and duty of the authorities, and more particularly of the assessing officer, to undertake all necessary inquiry, including to procure all the information on such transactions from other departments, so as to ascertain the correct facts and bring to tax such transactions to tax. If such approach is not adopted, it may lead to the assessee getting away with a bonanza of tax evasion, and the real income would remain to be taxed on account of a defective approach being followed by the department. Now, here was a case where assessee persisted with his objections to 69C, which were accepted by the CIT and the tribunal at a certain stage. And the tribunal has in a way, and the High Court has in a way said that there was a defect in the approach adopted because of the complete proof was not there. Now, that is why the percentage of profits. To the contrary is the case in the case of Kanak, where they say that this aspect, it only went on to say that there is, he says, para 18 it brought out The issue before the Commissioner of Appeals was whether the purchase had been proved, and the CATP, having observed against the assessee on this issue, ought to have confirmed the additions of the entire purchases. So this is where what has happened is this. So this aspect, so therefore, there is a qualitative difference between the two cases. Case where the purchases as such have been found to be bogus. With that, if that finding is survives, then you cannot proceed to only estimate a portion of the profits. That is the checks. That is the two difference between the two.
Sir, but one thing is that if the purchase is bogus, the sale is also bogus. Ultimately, what can be taxed the real income? That has not been discussed, I think, on this issue.
They have discussed that also. There's this. He says, para 19. They have taken care of all those typical arguments. You see, I will just read para 19 in that regard. It was nobody's case that both sales and purchase are unaccounted. If that be so, and the purchases have been recorded in the books of account by accommodation entry, then the same gets automatically reflected in the books of account. In the instant case, since the purchases are recorded by accommodation entry in the books of account and sales have not been disputed, the Commissioner of Appeals was not justified in estimating the profit when the basis of addition was not the low profits. See, that is the whole, they have gone into that. See, they have said that 69C, if you give a finding, if the finding consistently remains there, unless you find inadequacy in that finding of being bogus. That's all why the High Court in the first case used the word questionable bogus purchases. Because they found that, well, assessee is resisting that finding and there is no work done by the assessing officer on the other side to conclusively get a standard proof. And the word used is proper proof. In the absence of proper proof of bogus purchases, so there are questionable bogus purchases. In this case, they said, well, there is no way, you did not do anything before the lower authorities, you didn't even say why not is questionable bogus. So therefore, in that background, you cannot now go into the profit percentage thing. This is the basic thing. So what I'm saying is that, the contours, how you approach a litigation also makes a lot of difference. Like, for example, para 30 of the judgment is what has weighed in the mind. The person was not appearing before the AO at all. That is the case. So in Kanak, they note, we fail to understand that the respondent assessee, having consciously and intentionally decided not to join the investigations, cannot now contend that the revenue should have given them all the details before making the addition. They was wanting to know in the appellate stage, कि statement कहाँ है, वो statement दीजिए, confront कीजिए, all those stuff. There, in our view, such a conduct of the respondent assessee cannot be accepted. It was incumbent upon the respondent assessee to have joined the research proceeding, discharge the initial onus of proving the purchases and seek details, if any. Having not joined the research proceeding, the contentions raised by the respondent on this issue are to be rejected. Now, one of the contention was, look, I have given my confirmations, bank statements, all those documentaries I have given, which was also the case before the Bombay High Court in the earlier judgment. So therefore, but in the case of Kanak, the High Court noted that, well, what you did was in the original assessment proceedings, when this information from the department had not come. So when the research proceedings were initiated after having received the information, after that you have not cooperated, you have not brought in. So therefore you are not discharged in onus. So Therefore, it also matters as to how you approach your litigation. This is something which needs to be understood. There was a discharge of onus at a particular stage. Qualitatively, how the burden is discharged is another matter. So therefore, that is why you would find that there is a difference between the two judgments. I think that's in nutshell. So I think
Thank you, sir.
we can proceed further if time permitting. Otherwise, we'll
Yes, sir.
the time also.
Thank you, sir.
Okay.
Thank you, sir.
Yeah,
Thanks a
only
lot, sir,
one
for
thing, sir.
enlightening discussion.
Only one thing, sir. Hello. Only one thing, sir.
Yes, yes.
Honorable SMC bench of Bombay High Court in one of the cases by name ITO versus Kimchan Okchand Bhansali by order dated 3rd April 2025. They have distinguished Kanak, and they, as you rightly said, unless it is bogus, 100% bogus, otherwise profit can be estimated. In this case also, earlier the AO estimated 12.5%. Then because the purchases found purchase from the grey market, etc. Ultimately, tribunal distinguished Kanak Impex, and they said only 5% of the regular GP rate is to be applied, and they have distinguished Kanak Express. This is just for information, sir.
That's right. That's right. See, when you don't challenge the bogus finding before the tribunal of the CIT and straight away
Yeah, right.
talk of percentage, that is where the whole problem lies. Na?
That's right, sir.
And I read out
But
the question which was before the High Court. The question itself
yes,
says,
sir.
once accepted, it is bogus. Can you still do profit? So that is the difficulty.
Correct, correct. Then they also said if you are accepting 10% is to be allowed, that means 90%. No, 10% is to be allowed. Then 90% is we are allowing it.
Why they said so? Because in the background of the fact that there is accepted position, it is bogus.
Yes, sir.
That is the problem. No?
Yes, sir.
So we
So
can.
can we say, sir, this is on the facts of the case?
Sorry.
Can we say this judgment is on the facts of the case, and where
Absolutely right. Absolutely right.
and where the purchases can be proved, maybe from gray market, then and the sales are accepted, then percentage is to be applied, as you rightly say.
Yes, yes, yes.
Yes, sir. Thank you, sir. Yeah. Next, we would like to take Manoj ji or Sunil ji.
Yes, and now I'm taking another judgment of Ravi
Yes, sir.
Kumar Khanna, sir. Please. So, Sunilji, please you can stop your sharing so that I can share my presentation. Thank you, Sunilji. I'm sharing now. It's visible, sir. So, after discussing Sanjay Baweja, I'm coming to Ravi Kumar Sinha, sir. In this case, the basic contention is that when there is a lock-in period of the share, at the time of allotment, exercise of the option, whether we can take a difference between the market price and face value of the share at which the shares were allotted, that is the question of law in this case. And the facts of the case are, the assessee, Mr. Ravi Kumar Sinha, an employee, was allotted 11,50,500 shares under an EPESPS scheme at rupees 15 per share, which is a face value of share. The market value of share at the time of allotment was 49.95 per share. The employer obtained a valuation report from Ernst & Young, estimating the fair market value at 22.50 per share. There was a condition that 25% of the shares were subject to a 12-month lock-in period, and the remaining 75% had a 18-month lock-in period. The share certificate, which were handed over to the assessee, also carried an appropriate endorsement to the aforesaid effect. While filing his return of income, however, the assessee took the position that since the shares were not marketable in view of the lock-in period, the fair market value could not exceed the face value of the share, 15 per share. Assessing officer considered the market price of the share 49.95 and added the difference per share as a taxable perquisite under section 17 to 3rd A of the Income Tax Act. And surprisingly, this section 17 to 3rd A came for 1 year only. It came in the assessment by the Finance Act 1999 and removed by the Finance Act 2000. So it was there in the book for 1 year only. The assessee filed the appeal against the order of Lanadeo in the Office of Honorable CIT Appeal. The Honorable CIT Appeal, however, took the view that since the shares were subject to lock-in period and thus not available to be traded or transferred, it would be inappropriate to take the quoted price as appearing on the stock exchange for the purpose of determining FMV. However, and bearing in mind the valuation report, it held that FMV should be taken as INR 22.5 per share and took the perquisite value at ₹7.5 per share. Both AO and the assessee filed appeal for the Honorable ITAT, who sustained the decision of the Honorable CIT Appeal. And now both AO and assessee are before the Honorable Delhi High Court. This is the facts of the case. Issue involved whether the FMV of share allotted under an ESPS subject to lock-in period should be considered above the issue price for taxation as a perquisite under section 17 subsection 2 clause 3 of the Income Tax Act. Legal matrix section 17 3 A, the value of any specified security allotted or transferred directly or indirectly by any person free of cost or at concessional rate to an individual who is or has been in employment of that person, provided that in case where the allotment or transfer of specified security is made in pursuance of an option exercised by an individual, the value of the specified security shall be taxable in the previous year in which such option is exercised by such individual. And second, 222B, fair market value in relation to capital assets means the price that capital assets would normally fetch on sale in the open market on the relevant date. And where the price referred to in subclause 1 is not ascertainable, such price as may be determined in accordance with the rule made under this Act. So, when there is a lock-in period, whether the share market could fetch any price in the open market, that is the question. Revenue contended. The department contended that the FMV should be based on the prevailing market price of so and so per share, irrespective of the lock-in restrictions. And the difference between this FMV and the issue price should be taxed as a perquisite. The revenue has relied upon Rule 21 of Part H of Schedule 3rd of the Wealth Tax Act, which read thus: restrictive covenants to be ignored in determining market value. For the removal of doubt, it is hereby declared that the price or the consideration for which any property may be acquired by or transferred to any person under the terms of a deed of trust or through or under any restrictive convenience in an instrument of transfer shall be ignored for the purpose of determining under any provision of this schedule the price such property would fetch if sold in the open market on the valuation date. CIT Honorable ITAT finding a judgment also on the basis of law laid down as above by the Honorable Gujarat High Court and Honorable Delhi High Court in the case of Pramila Bali. It can be safely be inferred that the perquisite value of the share has to be computed by adopting the actual price paid by the appellant at ₹15 per share and the fair market value of the shares since there is a total ban on transfer, sales realization of the shares during the year under consideration. I am fortified in view by the recent decisions of the Honorable Bangalore High Tribunal in the case of Infosys Technology versus PCIT, wherein it was held that it can be interpreted that there exists no market for the shares under lock-in. In other words, no market value can be assigned to such shares. The market value of the shares for the employee is therefore defined and remains the price paid by him to be allowed, as in the case of Replomin Limited versus DCIT, holding that where the employee is not in a position to sell the shares during the stipulated time, he cannot meet the conditions of the stock exchange, and therefore it is incorrect to equate the value of the share so received to the quoted price. As the assessee has got the valuation done from the expert as per which the value of share comes to 22.50, employer had accordingly acted on such determination by an expert and deducted appropriate taxes after treating the difference between the amount of the employee and the value, and thus determined as a perquisite includable in the income under that said. The assessing officer is accordingly advised to recompute the value of perquisite in terms of section 17(2) third A of the Act between the fair market value of the shares at ₹22.50 and the actual price paid by the appellant. So this is the finding of CIT appeal and the Honorable ITAT. Now what the assessee contended. In light of the lock-in period which operated, the concept of FMV could not have possibly been imputed or adopted. The Act itself does not contemplate a tax being imposed on national income. The concept of FMV itself contemplates the price being determined with reference to what a capital asset would fetch on the sales in the open market and on the relevant date. Insofar as valuation report is concerned, the same had been obtained by the employer of the assessee only out of abundant caution and in order to ascertain its liability with respect to withholding tax obligation. The valuation report thus could not have possibly constituted or be liable to be viewed as a determinative factor of FMV. The reliance was placed on the judgment of the Karnataka High Court in the case of CIT versus Infosys Technology, and which ultimately came to be affirmed by the Honorable Supreme Court in CIT versus Infosys Technology, in which the Honorable Supreme Court held the shares were not transferable for 5 years lock-in period. During the said period, the said shares have no realizable value. Hence, there was no cash inflow to the employee on account of mere exercise of option. On the date when the option were exercised, it was not possible for the employee to foresee the market value of the shares. Therefore, in our view, the benefit, if any, which arose on the date when the option stood exercised was only a notional benefit whose value was unascertainable. Therefore, in our view, the department had erred in treating 165 crore as perquisite value, being the difference in the market value of shares on the date of exercise of option and the total amount paid by the employee consequent upon exercise of the said option. Further, it held that question is whether every benefit received by the person is taxable or income. In our view, it is not so. The important word is unless the benefit is made taxable, it cannot be regarded as income. During the relevant assessment years, there was no provision in law which made such benefit taxable as income, as well as lock-in period, and a potential benefit cannot be regarded as income. Further, reliance was placed on the judgment of DCIT, Deputy Commissioner of Gift Tax, where the Supreme Court was concerned with the promoter quota share and which too were subject to lock-in restrictions. Those promoter quota share had come to be gifted by so-and-so company to another company. The question which arose for consideration was the value liable to be attributed to that gift in terms of provisions made in the Gift Tax Act. This is one important para to read. For this, reference was made to the provisions inherent in Schedule 3rd of the Wealth Tax Act, Rule 9 as appearing in Schedule 3rd. Quoted share or quoted debenture. What is quoted share? In relation to an equity share or a preference share, as the case may be, a debenture means a share or debenture quoted on the recognized stock exchange with regularity from time to time, and where the quotation of such shares or debentures are based on current transaction made in the ordinary course of business. Explanation: where any question arises whether a share or a debenture is quoted share or a quoted debenture within the meaning of this clause, a certificate to that effect furnished by the concerned stock exchange in the prescribed form shall be accepted as conclusive. In the case in hand, this is not a quoted share because they are not being regularly traded on the stock exchange, and there is no price being determined because of that. Ultimately, Supreme Court held we are in agreement with the view expressed in the impugned judgment, which observes that equity share and the lock-in period were not quoted shares, for the simple reason that the shares in the lock-in period were not quoted in any recognized exchange with regularity from time to time. What is important was regularity. With regard to valuation under Wealth Tax Act, which were observed and referred by the revenue, the reference was made to the Crossman's case, wherein it was held that the expression, if sold in the open market, does not alter the nature of the property. What the expression postulates is to permit the assessee or the authorities to assume a sale in the open market, which is to limit the property to be valued at the price that a person would be prepared to pay in the open market with all rights and obligations. The value would not exceed the sum which a willing purchaser would pay, given the fact that the right to purchase is restricted or barred. This does not imply that valuation of the shares can be made artificially and by ignoring the restriction on the property. Valuation cannot ignore the limitation attached to the shares. The judgments in Crossman case has been subsequently reiterated by the House of Lords in Linen and Inland Revenue Commission and by High Court of Australia in Abraham versus Federal Commission of Taxation and a division bench of Madras High Court. Honorable Delhi High Court reasonings while determining the case. Bear in mind the well-settled provision law of the Act not contemplating a tax being levied on national income. We deem it apposite to extract the following passage from the decisions of the Honorable Supreme Court in CIT versus Excel Industries Limited. This court did not accept the view taken by the High Courts on facts. Reference was made in the context to CIT versus Birla Gawaliar, where it was held after referring to movie industry that real accrual of income and not a hypothetical accrual of income are to be taken into consideration. For a similar conclusion, reference was made to Pune Electricity Company, wherein it was held that income tax is tax on the real income. Finally, reference was made to State Bank of Travancore versus CIT, wherein the majority view was that accrual of income must be real. Honorable High Court referred three tests to be applied, namely, whether the income accrued to the assessee is real or hypothetical, whether there is a corresponding liability of the other party to pass on the benefit, and the probability or improbability of the realization of the benefit by the assessee, considered from a realistic and practical point of view. Ultimately, Honorable Court held, in our considered view, in the light of the restrictions with regard to marketability and tradability of the stock in question, FME could not have been recognized to exceed the face value of shares and thus determinative being rupees 15 only. The valuation report, as noted above, was at best a medium adopted by the employer in order to broadly ascertain its obligation for the purpose of withholding tax. The same could not have consequently been taken into consideration for the purpose of FMB. We accordingly answer question number 1 posted in the affirmative and in the favor of the assessee. My observation, a benefit cannot be taxed or taxable until it is enjoyable by the assessee. That is, all the rights relating to it accrue to the assessee. Now the question is, when the lock-in period is removed, whether it will be taxable in the year of removal of lock-in period or not. If not, when, or only capital gain will be taxable at the time of sale of share by the assessee. Now, sir, this is the brief of the judgment.
Yes, I appreciate it. I think we'll quickly go through. You see, the controversy before the High Court revolved around how to ascertain the valuation for that perquisite of shares. primarily how to value. Because the share had a issue price of rupees 15 and the market price was 49.45 paise that day. And the employer had, as Manoj had explained, that the employer had obtained a valuation report from Ernst & Young for the purposes of his own record and purposes, where the valuation was determined at 22 rupees and 50 paise. When the matter came before the assessing officer, he valued the perquisite as a difference between 49.50 minus the price. The CIT appeal agreed with the assessee and took the fair market value at 22.50 paise, which is the Ernst & Young price. Although the case of the assessee was that the shares which I have, some portion of them have a lock-in period of 12 months and some portion of my stock holding have a lock-in period of 18 months when I got the share, when the allotment was made to me. So therefore, the valuation determined by the valuer could not be taken as the fair market value. So that is how the matter reached the Honorable High Court. The first and the foremost point made by the assessee was that, look, when you value this benefit of perquisite, at the time of valuation, I could not trade in these shares, I could not sell these shares. So therefore, it can at best have a notional value for a notional advantage to be. A notional value could only be ascribed. So section 2, subsection 22, capital B, which defines the fair market value, was pressed into service before the Honorable High Court, and they have appreciated that. Fair market value in relation to capital asset means, one, the price that the capital asset would ordinarily fetch on sale in the open market on the relevant date. So it presupposes two things. Price ordinarily fetching on sale in open market. And the Delhi High Court has extensively referred to the Infosys Technologies as also the case of BPL Limited. BPL was a case where the promoter quota shares which were subject to lock-in period, they were gifted by BPL Limited to Celestial Finance Limited. And the question which arose was the value to be attributed to the gift in terms of the Gift Tax Act. So the Supreme Court in BPL took into consideration the fact that here is a case where the shares have a lock-in period, they cannot be freely traded. The SEBI permitted that within the promoters this could be transferred, but it was a restrictive availability of transfer, very restrictive, and therefore under these facts it tried to explain what is the meaning of fair market value. We will go a bit fast. It is in that context that they said that you could not take them as quoted shares. it is not as if these shares did not have the price was not available in the stock exchange. The price was there of that corresponding share, but since these particular number of shares were not tradable, they could not be sold and bought in the open market that is the stock exchange. So therefore, the court should look, if you go to the rules of valuation of the Wealth Tax Act, that's where what the Gift Tax refers to. So you may have to go and look at how the unquoted shares are valued. That's one aspect within. Other aspect which they considered was that the rules of the Wealth Tax provide, Schedule 3, that if there are any restrictive covenants on any property, they shall to be ignored in determining the market value. But the same rule said that these restrictive covenants can be ignored for the purposes of determining under the provisions of the schedule the price such property would fetch if sold in the open market on the valuation date. So the rule permitted the authorities to, in spite of the fact that the goods are not tradable, the shares were not tradable, it said you must determine if it were to be sold in the market on that date of valuation, what will be the price. And the court interpreted to say, they fell back on a very old judgment of Ahmed G. H. Arif, 76 ITR 471. To say that the observations, if sold in the open market, is important. But what it means is not the actual sale, but to assume that there is an open market and the property, even with the restrictions, can be sold in such market, and on that basis the value has to be found. The Supreme Court has been extensively quoted, and I will just read out few lines from there. The expression, if sold in the open market, does not alter the nature of the property. What the expression postulates is to permit the assessee or the authorities to assume a sale in the open market, which is to limit the property to be valued at the price that a person would be prepared to pay in the open market with all the rights and obligations. The value would not exceed the sum which a willing purchaser would pay, given the fact that the right to purchase is restricted or barred. So what they're saying is, you have to, the rules provide you value as if these restrictions also come into play. What will be the price which is paid by a willing purchaser considering those restrictions? They go on to say, this does not imply that the valuation of the shares can be made artificially and by ignoring the restrictions on the property. Valuations cannot ignore the limitation attached to the shares. So therefore, that is why they went on to say that the assessing officer's adoption of the market price of 49 rupees cannot be the market price, cannot be the fair market value, fair market price, because of the restrictions. I am only saying in a nutshell. Then they also dwelt on the real income theory to arrive at what is the most probable value which can be asserted in such manner, which has the restrictions. And ultimately, they agreed with the assessee's position that with these covenants and lock-in period, the fair market value could not have been recognized to exceed the face value of the shares, which was rupees 15. So in that sense, what was done by the lower authorities, the tribunal and the CITP both, that the valuation report given by the valuer was substituted as the price of a fair market price was not taken into consideration. So therefore the High Court in that sense has gone back to the principles of understanding what is fair market price or fair market value. Something which is a willing purchaser in an open market is willing to pay the price, and since these shares had those lock-in period covenants, so what could have been paid with these covenants? To assume the shares will remain still the shares, it doesn't alter the nature of the property as the Supreme Court explained, but it brings into the factoring of those restrictions. So with that bent of mind, with this logic, with this principles, they have gone on to say that yes, the face value itself be taken as the fair market value on that date that's professed by the SEC. And that's how the whole judgment lies. It's basically principles of valuation, how to value the perquisites in the present case. So see, this other observation on benefit can be taxable, only it's enjoyable. All this is only they have explained in order to reach that position. That was not the subject anyway before them. So they referred this to when they were analyzing the judgment of the Honorable Supreme Court in the case of the Kanak Impex judgment, which later was affirmed by Supreme Court in that Infosys. So therefore, the question before them was very limited. The valuation, fair market value for perquisite, that's for all. I think we can move to the next section because otherwise we'll...
Sir, one only question left. Whether it will be taxable now in future when the lock-in period is removed, or it will be taxable at time of capital gain when he sells the share.
No, they have already valued the perquisite and taxed it here, Baba. It turns out to be it is nil, that's another matter.
Okay.
See, they are valuing the perquisite and taxing you. What follows subsequent will be, your act will guide you.
Now,
The question of how the perquisite is valued, that's the taxability here.
Okay, Sunil, now you take over third case study.
So we just have 7 minutes left. So, we request either we extend it for 5-7 minutes, or if you will be able to complete it within 10 minutes.
I don't think they can complete, but do we have another session, or how do you plan in such situations?
I can complete third case in 5 minutes.
Okay, then we can do that. At least one set will be complete, at least in that case.
I can just go.
Yes, sir.
Thank you.
Third case study is of PCIT Center versus Karina Airlines. In this case, the issue is the limitation period under section 153C to go back beyond 6 years, or how to count the period of 6 years, or from which date, whether it's a period of search, date of year of search, or whether the year in which the satisfaction note is made by the AO of the other person, because in the case of 153C. So I'm just taking the facts very fastly. On April 7, 2016, a search was conducted under section 132 of the income tax in the case of Ms. Harval Chawla. Satisfaction note, Mr. Chawla recorded on 29th March 2019. For Karina Airlines, no such person recorded on May 15, 2019. Based on the satisfaction note for Karina Airlines, the AO initiated proceedings under section 153C for assessment 12/12/13 and passed an assessment order on 31st December 2019, making addition approximately to so and so. The SSC appealed to the Honorable CIT appeal, who provided partial relief on merit. Both revenue and SSC appealed to the Honorable ITAT, which quashed the assessment on the ground of limitation. Issue involved whether the assessment proceedings initiated under section 153C for assessment year 12/13 were barred by limitation, considering the amendments introduced by the Finance Act 2017. Further, from which date the period of limitation is to be counted. The amendment in 2017 was increasing the time limit from 6 to 10 years and was applicable for such took place after 1st April 2017. Argument by the department contended that the amendment to section 153 C by the Finance Act 2017, which extended the assessment period to 10 years, were satisfactory and should apply retrospectively. They argued that the relevant assessment years should be determined based on the data of the search. And since the satisfaction note was recorded after the amendment, the extended period should apply. Emphasize that the AO for both the search and non-search person were the same, negating the need for physical transfer of documents. Argument by the SSC argued that the amendment to Section 153C was prospective, effective from 1st April 2017, and could not apply to search conducted before that date. Contended that for search conducted prior to such period, the assessment period was limited to 6 years, making the assessment for 12-13 years time barred. Asserted that the date of recording the satisfaction note, that is 15 May 2019, could not retrospectively extend the assessment period. So, as per the satisfaction note, the possible 6 years could be financial year 18-19, 17-18, 16-17, 15-16, 14-15, and 13-14, not the financial year 11-12, for which the addition was made. Finding by the Honorable Judge, the court held that the amendment to Section 153C introduced by the Finance Act 2017 were prospective and applicable only to search initiated on or after 1st April 2017. Since the search in this case was concluded on 7th April 2016, the extended 10-year assessment period would not apply. Thus, for assessment year 12-13, assessment is beyond the period of limitation and barred by limitation. Reasoning for the decision, the court emphasized that legislative intent was evident from the provisions was to apply the extended assessment period prospectively. The date of search is the determining factor for applicability of the extended period and not the date of recording of the satisfaction note. Even if AO for both the entities is the same, the statutory requirement of recording a satisfaction note and time thereof are crucial for determining the limitation period. And for this, the reliance was placed on the Supreme Court judgment in CIT versus SSP Aviation and CIT versus Justice Singh, which clarified the interpretation of so and so. The Leh Court does dismiss the revenue appeal. And for key takeaway, for searches conducted before this, assessment period under Section 153C is limited to 6 years, and the extended 10-year period introduced by Finance Act does not apply retrospectively. Thank you, sir.
I think very quickly, this is a very fact-driven judgment, and you see, the Honorable High Court has also referred to the Supreme Court judgment in the case of Justice Singh. Now, if you go to the logic, what they have gone by is, according to them, so far as the searched person is concerned, the assessing officer goes by the provisions for 6 years, he identifies that, and so far in the case of a non-searched person is concerned, that can, in that case, it is 153C which is triggered. Anyway, we are talking of those period only intermittently. Later on, of course, the law has changed now. These sections may not be very relevant. 53C gets attracted only when the assessing officer of the searched entity identifies documents or material which are found to relate to a person other than the entity which is subjected to search. Now, this is the first starting point. In such contingency, assessing officer is obligated to transmit the material to the other person's assessing officer. The AO of the non-searched entity is thereafter required to scrutinize the material so received and then have to satisfy himself whether it has an impact on the determination of total income of such other person. Now, this is what the High Court has read the entire section. So therefore, what they formulated is, unless the AO of that other person is satisfied that the material is so gathered is likely to have an impact on the determination of total income, the mere receipt of document would not suffice. So therefore, in that context, they have said to identify the number of years that becomes critical. The aspect of the AO of the search person sending material, transmitting material is a step in the aid of formation of opinion. Whether 153 is merited, 153C is merited or not in the particular case to initiate it. Therefore, they say, thus, even in a case where the AO of the searched and the non-search party are one and the same, it would have a bearing on the formulation of a belief that material is likely to have a bearing on the determination of total income. In that sense, why this paragraph in that judgment is, one of the argument was, that look here, the assessing officer of the search person and the non-search person is the same. So therefore, you cannot put into motion this theory that the identification of the years will be different. Anyway, so therefore, they lead to say that in such cases, it would be the date when the AO records its satisfaction with respect to the non-search entity, which would be of seminal importance and constitute the bedrock for commencement of action under 153C. Now, this is what they have said. Now, looking at the amended 153C, which said that it is to be for searches prior to the particular date, I think 2017, that was the date, and this search being on 7th April 2016, so that is why this ruling. I think much can be said about it. Need not go into this, but that's how the whole judgment has relied. This is basically a fact-driven judgment. If you have any questions, we can look at them.
Any questions, friends?
No, sir, I think all questions are sorted already. Been answered.
So what do you suggest? We can now close because the time is.
Yes, sir. Yes, sir. We can now close because we exceeded our time, and I'll request Ashok sir to give vote of thanks to Pannu sir and to other speakers.
Yes, sir. Yes, sir. Thank you. Thank you for opportunity. Friends, you will all agree with me that discussion of case laws by Mr. Manoj ji and Sunil ji was quite informative and enriching. Chairman sir's remark was icing on the cake. Chairman rightly said that the purpose of the discussion on judgment is to know and understand the legal principles in the judgment rather than the conclusion. Chairman sir, with his rich and experience and thorough knowledge, enlightened us and gave his concluding remark. Thank you so much, sir. Thank you, Manoj ji. Thank you, Sunil ji. And thank you, Pannu sir. Friends, I will also like to recognize the presence of Prashant Maharshi sir, who is always there to guide us in such webinars. Thank you, Prashant ji. And now we can call it a day we can close the meeting. Thank you so much.
It is heartening to see Brother Prashant back in action. All the very best, brother. God bless you.
Right. Thank you so much, sir.
Thank you, everybody. Thank you.
Thank you, everybody. Thank you.
Thanks.